radio for a really great future. We're talking real money.
Well, if it's Friday, it's got to be question day. Question and answer day, because the two kind of go together. You know, you ask questions and I try to provide answers. Hi, everybody. I'm Don McDonald, on my way across the country still, but almost done. This program is being recorded in Chelan, Washington, as I am enjoying a pseudo vacation, teeny tiny moments of leisure with my co-host Tom and his family. So, but I'm taking time away from going out on the lake with Tom in his boat to record this, to answer your questions, because you guys are important to me. If you have a question, well, there are several ways you can ask it. One, you can do like everybody in this episode did, and that is go to talkingrealmoney.com and record your answer using the contact form and then clicking on the little mic button. It's so easy. But go ahead and record it. You'll see why I say that, because I had to edit this first question, because it's not voice recognition. It's actually recording your voice. So you don't need to put periods and things in. Just I record what I edited that stuff out. So just record that, or you can type it there at talkingrealmoney.com, or you can call us and actually speak with us face-to-face, voice-to-voice. We don't see you. Every Saturday when we do our show on Northwest News Radio in Seattle, and then that becomes the podcast next week. So just go to talkingrealmoney.com, or on Saturdays, call us from 3 p.m. to 5 p.m. at 855-935-8255, which just happens to spell talk. And now, here's that first question we were talking about.
I have a 28-year-old grandson. I'm trying to help do some investing. You mentioned in one of your recent podcasts that investing in two funds would be satisfactory because he has a long time horizon. The two funds you mentioned are APG and AB, as in boy, G. I found it hard to hear those correctly, as I have hearing issues. You could advise two funds or any two funds that might be worthy of investment for a young man. Thank you.
Well, I'm guessing just by the letters you gave me that the fund, they both kind of sound like the same fund, which is AVGE, which is the global equity fund, the global equity ETF from Avantis. The letters are A as in Apple, V as in Victor, G as in George, E as in Edward. That is a total market fund with a tilt towards smaller companies and more value-oriented companies, which we believe could be great for a younger investor because of the time factor. It will also be a very volatile fund. That means in bad markets, it'll go down, but when you're young, down is good. Down is actually better than up in the early years of investing. You see, young investors shouldn't hope for the market to go up right away. They should hope for it to continue to fall as they add money. It's hard to stomach, but that's the reality. The other that we recommend or suggest, not really recommend because we don't know all the details of the people, but it has given you the return of the stock market, which has been impressive over time, and that is the Vanguard Total Market ETF, which is just VT, Victor Thomas or Victor Tango. I don't know the military alphabet. Tom learned it once, I think. I think he forgot it too. So those two would be great funds for someone his age. And thanks so much for the call. Another question that came in through talkingrealmoney.com.
Hello, Tom and Don. I am 62 and I have $1 million invested in my 401k in the following 5 funds. 35% in Fidelity's FBGRX, 35% in Vanguard VBTIX, 10% in VONV, 10% in TRSSX, and 10% in VTSNX. So it's 35% in a growth, 35% in bonds, 10% in value, 10% in small caps, and 10% in international. I would appreciate a quick evaluation and assessment of that. For 62, I plan to retire when I'm 68. Thank you.
Well, it's tough to give you an opinion about whether it's right or not for your age, because there's no such thing as being right for a particular age. The portfolio allocation, the stock to bond ratio. I mean, I think yours is reasonable for your age, but it's more a matter of your risk profile in total, your needs, and then your risk tolerance combined that should determine your stock to bond allocation. However, I think your other allocations are not great. I don't think this is a great allocation. I think you're way underweighted in international. Your equity position should probably be about 40% international. It really should. That's about the right ratio to own the equivalent of the market. And when it comes to investing, we believe in the research that shows, that has shown consistently over very long periods of time, that small company stocks and value stocks have tended to outperform the growth-oriented large cap. You are heavy large cap. You're paying too much for the Fidelity blue chip. You're paying way too much for the T. Rowe Price small cap fund, which, by the way, is a small cap growth fund. We'd rather see, if you're going to go into small cap, go small cap value. But here's what you're doing. It's not as complex as some I've seen, but you're making it more complex than it really probably needs to be. You could use, for example, a Vanguard Total Stock Index, which will give you almost that 60-40. You could throw into that a VBR, a Vanguard Small Value Fund. You could throw into that the VBTIX or BND, which is the total bond index for your bond portfolio, and let that go. There you go. You're done. Or you could do an AVGE, the Vanguard or the Avantis Total Equity Index, the Global Equity Index, and use your bond fund and get your 60-40 or 70-30 split or whatever is right for you. But you're paying too much, except for the Vanguard funds, the Fidelity and the blue chip. I mean, the Fidelity blue chip is about 0.5%, which for an ETF, a fund, is too much. And the T. Rowe Price is 0.66, which, again, for an index fund, it's just outrageous. Those are ridiculous fees. So I'd make some changes. I mean, overall, the concept is fine, but not the best mix I've seen. Thanks so much for listening. Thanks for the question. And let's grab another right now, shall we?
Dear Don, you should be very jealous of Tom for his trip to Kenya. I lived in Kenya for 9 years, and it is a marvelous country with wonderful people and astounding natural beauty. Hey, I have an idea. I think you should do Cape to Cairo next summer in your Airstream and plan a long stay in Kenya. Now on to my questions. You and Tom continually say, have a plan and take only the risk that meets the needs of the plan. You also argue for making rational choices that are not affected by psychology. Academic research has shown unequivocally that equities have better returns over the long term than bonds. Is it not the most rational choice to invest in the most successful investments, that is, a diversified portfolio of equities, and avoid bonds? Of course, a 100% equities portfolio requires staying the course, emotions be damned. But isn't that the very definition of rational? Making decisions based on reason and fact, not subjective feelings. Should we advise people to learn to control their emotions and invest more in equities?
Well, Mr. Spock, yours is a two-part question, so I'm splitting it in half. Yes, of course. If we were rational, reasonable creatures, that would make perfect sense. There would be, bonds only serve one purpose. They really do, in our opinion. They only serve one purpose. The only purpose they serve is to mitigate volatility. They tend to reduce it some. They have. They've reduced volatility over time, not completely eliminated it, but reduced it. And the reason we suggest them is because you will never get a totally rational human being. Totally rational. You may have degrees of rationality and emotional control, but think about it. Do you really believe that the majority of human beings can act rationally in their best interest without any emotion? Come on, you know the answer. We have to have bonds in the portfolio because people are people and we panic. And if you're looking at a total portfolio, you get your statement at the end of a quarter and you go, oh, I'm down half. I'm scared. You're likely to do something stupid. If you get your statement and you're down 25%, it doesn't hurt as much. And that's what bonds do. They add that ballast to keep the portfolio from sinking. Wait a minute, ballast would actually make it sink. They add buoyancy to keep the portfolio from sinking. So yeah, no, in a rational world, sure, but we don't have one. Sorry. Now to your next question.
My second question is based on the first one. I'm in my 40s. I have enough invested that I might be able to be financially independent by my mid-50s if I maintain an all-equities portfolio. Am I foolish for swinging for the fences, knowing that by avoiding bonds, all I'm risking is a delay to my financial independence? Yes, the markets may go down or sideways for 10 plus years at a time, but by choosing 100% equities, I know that I will be financially independent at some point before I reach 70, and probably a lot sooner than that. Am I wrong? Thanks.
Of course you're not wrong as a Vulcan. It's perfectly logical. No, I'm joking again. I'm not making fun. Of course, if you're 100% certain or 99.9% certain that in a disastrous equity decline, you're not going to freak out and sell and really hurt yourself, then you're right. At least based on the past, investing entirely in a global equity portfolio that leans a little small, leans a little value, is rebalanced, has been a very effective path to building wealth more rapidly, quite a bit more rapidly over the course of decades. So, yes, the answer to your question is yes, you would be better off, probably. I mean, again, we don't know the future, but you would have been better off in the past. So if you want to swing for the fences, swing for those fences, but be confident of your ability to control those emotions. You have a question for us? Just send it in at talkingrealmoney.com. Either speak it or type it, or every Saturday, call us at 855-935-8255 between 3 and 5 Eastern. Oh, and by the way, I forgot to mention, yes, I was a little jealous of Tom on his trip to Africa, but he's the rich member of this team, and I could not possibly afford the trip. Debbie saw pictures last night, and there's no way I could ever afford that trip. No way. I could not. No. Dream. And I am not taking the Airstream from South Africa to Cairo. That's never going to happen. But thanks for the thought. All right, let's go to the next question, shall we?
Hey, Tom and Don. Mike from Colorado calling. And hey, Don, I'm not on the bar trail today, so hopefully you can hear me a little bit easier. I've got an interesting question. Maybe it's just a topic that I would hope that maybe you guys could devote a bit of your show to, and it has to do with WEP and GPO. WEP being the windfall elimination provision, and GPO being the government pension offset. And Don, you're probably pretty familiar with it. I believe your daughter's a teacher, but my wife is a teacher as well, and this probably applies to a lot of your audience members, government workers, people that are not necessarily contributing to Social Security, but get a government pension. And that's the case with my wife. But the issue I have, and I would love to hear your thoughts on this, my wife was in the private sector, and she definitely qualified for Social Security, earning enough credits to qualify that. And if she never was a teacher, she would get her full Social Security payout and no questions asked. But because she's a teacher and she's actually going to retire in a couple of years, we started with the calculations, and the windfall elimination provision reduces her Social Security significantly to where it's pretty much nothing what it would have been. And more importantly, the GPO, which is the government pension offset, takes 2/3 of her monthly pension and takes that out of spousal and survival benefits regarding Social Security. So that is just a killer. And I don't think it's fair. I believe people are trying to get it repealed. But like I said, if she never was a teacher, she would get a full Social Security payout. She would also get a spousal benefit, which would be my Social Security when I collect at 70. And the spousal benefit is huge as well, because if I die, obviously I'd want her to have my full payout, but it's reduced significantly because of that GPO. So I just was curious if you guys, I know you probably have run into clients with this WEP and GPO factored in, and what your thoughts are. You think it's fair for somebody that works in the private sector, qualifies for Social Security, and then decides to become, in essence, a teacher, maybe a firefighter, whatever, and all of a sudden those payouts that they put into Social Security are significantly reduced? So that's my question. Maybe table it for a topic on your show. I'd love to hear your thoughts. Thanks.
Well, thanks for the call. Yes, we do run into this. The windfall, these were, I'll give you a little history. The government pension offset, the GPO, was enacted in 1977 as part of an effort to save Social Security. I was a young man back then. I don't remember a lot about it specifically, but it was to make the system a little more fair. There were a lot of people upset about double dipping government employees, double or triple dipping government employees. They were collecting pensions from various government agencies and then also collecting Social Security. So that law was enacted to address that, as was the windfall elimination provision, which was in the 83 Social Security bill that changed a lot of Social Security. This is all part of the very complex world of trying to figure out how to save Social Security. And it has been a complex, convoluted, infuriating for many process. And of course, it infuriates anybody who sees less money coming in because of it. It is going to make you mad. I totally get it. But while I'm pretty good with investing, I am certainly not enough of an expert to get into whether or not what this would do to Social Security currently. I know that there's currently discussion in Congress about eliminating them. Whether that'll happen or not, I have no idea. They always get a lot of attention because those constituencies who lose money are very vocal. I don't know enough, and I am certain that Tom doesn't know enough to really have an opinion one way or the other. I can tell you that, of course, if I was a teacher, my daughter was only a teacher for a year and a half. If I was a teacher and I was getting less money, I'd be concerned, at least. I don't know. But I'm one of those people who says, I make more money than the Social Security cutoff. I think you should tax me past that point. So maybe I wouldn't. I believe that it's, you got to save the system. The system has to survive for those who can least afford to retire. And that's the primary goal of it. It was designed to save people from poverty, not to be our pension income. We were all supposed to be dead by 65 when they signed these into law. Well, Social Security into law. So I'm not going to get into that debate because I don't think that's the purpose of the program, but you were able to do so. So I gave you that opportunity, and thanks so much for calling. And now on to the next question.
Hi, Tom and Don. I'm a huge fan of your show and have been an avid listener for close to a year now. My question has to do with small cap value index funds. I'm definitely a believer in the concept and own a good amount of them in my portfolio. But I've been thinking lately about a possible problem with them. Now, small cap value funds, I'm assuming, do well because you have those hidden gems in there that are going to grow and become big, stronger, profitable companies. The issue, if that happens, would they now be filtered out of the small cap value index fund? Because now they would be now classified as either a small cap growth fund or a mid cap or large cap fund. In other words, the fund would be essentially filtering out these successful companies as they become successful. A follow-on question had to be, if that's the case, would it make more sense to be in a total stock market index fund that weighs heavier into small cap value, which I believe you said Avantis has something to that effect, in which case the small cap companies that were heavily weighted in as they grow, we're still holding on to them and not filtering them out of our index fund. Look forward to hearing the answer. Again, love your show. Thanks.
Thanks for the comments. We humans, we are thinkers. We are overthinkers. We are always overthinking everything. Yes, this is why we suggest a well-diversified portfolio, just because of this thought process. It's only because of this thought process, not just... It also makes it a more comfortable process. If you own the whole market, you get the performance of the entire global economy, which is reasonably has been reasonably good. However, had you just owned small cap value since almost 100 years, just owned small cap value, despite the fact that the bigger companies would have dropped out of that index, you would have made about a little less than 3 times more on your portfolio, because when they're in their tiny phase and they grow, the growth is dramatic. It is a large percentage. The largest percentages of growth tend to occur early on, and then that growth tends to slow. While the numbers get bigger, the percentages get smaller. So when they get to be big companies, they, as a percentage of growth, they don't grow as fast. When you go from tiny to mid cap, that percentage of growth can be pretty extraordinary. I mean, it can be triples and quadruples and quintuples. Whereas when you get to be big, going from $1 trillion, well, you're not going to go from $1 trillion to $5 trillion in short order. It's just not likely to happen. It doesn't happen. Hasn't. So that's the reason. You would have done a lot better if you were just in small cap over the past 100 years. You would have. It's a fact. But you would have been more comfortable if you diversified. And by diversifying, you just continue to own the global economy, both the good, the bad, and the ugly. Both the good, the bad. That's 3 things. All of the good, the bad, and the ugly. And it's probably better for most people to do that, because just owning small cap would also have been extremely scary. Very scary. And I think that's the note on which we will leave this. Thank you all for being a part of it. If you want to ask questions, go to talkingrealmoney.com, click on the contact form. If you want to spend a little bit of time with one of our advisors with a longer question, or somebody to look over your whole portfolio, we'll do that for nothing. Without any high-pressure sales pitch, just click on the button that says Meet an Advisor. We'll do that. And you can also please call in your questions on Saturdays, particularly in the summer. It's easy to get in at 855-935-TALK every Saturday from 3 p.m. to 5 p.m. Eastern Time, noon to 2 Pacific. Tom and I get together almost every Saturday unless one or the other of us takes a vacation or it falls on Christmas. Otherwise, we're pretty much there the whole time. 855-935-TALK every Saturday, talkingrealmoney.com, the contact form for every other question. Please tell some other folks about the show. Don't keep it to yourself. There's no reason, because it's not a finite resource. As a podcast, it's pretty much infinite. There may be aliens listening. I guess there could be. Anyway, if you believed in that. I'm Don, and I continue to head west, and I'll be talking to you next, definitely from Seattle. So thanks for being there. Take good care. We'll be here for you almost every day, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.